This is Scott Becker with the Becker Private Equity and Business Podcast. We're joined today by a brilliant leader at RSM. We're joined by Matt Wolf, and Matt watches regularly the intersection of healthcare and private equity. He's going to talk to us today about some of the trends he's watching in the healthcare deal world, the healthcare deal space. Matt, let me tee you up and have you take it away. Talk to us about a handful of the trends that you're watching in this area.
Yeah, happy to, Scott. Is one thing that we watch closely are sort of the dollars invested into private equity healthcare or private equity backed healthcare portcos sort of by year, by vintage, and how that relates to sort of timing expectations as we try to model out and examine potential deal flow. And sort of the conventional kind of anecdotal knowledge or wisdom that's been floating around, of course, is sponsors have been waiting for the right time to exit, right? They need to meet their IRR thresholds. They need rates to go down, financing to become cheaper to help facilitate that deal flow. They can hit their exit targets. And what we've seen certainly in the capital market side is even as the Fed started to lower the front end of the curve, we've seen interest rates on the longer end that sort of better informs the private credit that finances a lot of these deals. Those yields have actually increased, right? And so it's another way of saying that the interest rate environment is unlikely to get much better or much more supportive of deal flow. And we've already seen some sponsors sort of rip the Band-Aid off, for lack of a better term, and exit a lot of these positions as they allocate capital towards new funds, new investments, allocate their operating partner, their deal team talent to new investments and new businesses. And we're going to see a lot more of that, I think, in 2025. I was, just based off of PE buyout investments in healthcare, sort of healthcare broadly defined, excluding life sciences. We have right now about 2,200 companies that are outside of the typical 5-year hold for private equity. We have another almost 900 companies that saw their last sort of private equity buyout over 7 years ago. And again, this is just sort of healthcare broadly defined, excluding life sciences. And those, the dollar value, at least of their last sort of buyout investment for the portcos outside of 7 years, was over $42 billion, according to PitchBook data. That's primarily what I look at for this type of analysis. And that's a lot of money. 115 billion outside of the 5-year hold, again, for this sort of semi-broad definition of healthcare. And I think sponsors they realize like the interest rate environment is not going to become more accommodative to deal making, and we're going to see a lot of this change hands in 2025.
Right. And so part of the core point is that regardless of the interest rate environment, there's been some softening of it, but very little. But people are really ready to put money back to work. This is what they do for a living, so they're trying to figure it out. And that's what you're starting to see. And what does that delta still look like between buyers and sellers? Is that delta between what sellers want to sell at and buyers want, is that starting to get lower?
It is. I'd say broadly across healthcare. The real question, what we're continuing to watch, is what is that bid-ask spread for healthcare services, for providers, for businesses that accept reimbursement risk? Because I can tell you, based on conversations I've had with a lot of sponsors in the space, there are many who's, they're committed to investing in healthcare. They no longer want to invest in companies that take direct reimbursement risk. They don't want physician practices. They don't want hospitals. They don't want senior care. They want to put their money to work into health technology that will help support those businesses, or suppliers that will help support those businesses, or other sort of kind of a pick and shovel sort of play. They're committed to healthcare, but they're leaving the services business. They don't want that reimbursement risk. And so as the potential buyers of these healthcare providers that need to flip to a new PE, as that pool of buyers sort of shrinks, I think we might continue to see this bid-ask spread delta, at least in healthcare services, that will sort of maintain, even if it shrinks in other areas of healthcare.
Right. Like, so in the true practice management stuff, things are staying a little bit tough. The margins are tough. Reimbursement is tough. Inflationary costs make margins tough. So everything's a little bit more challenging there in true reimbursement areas. And all the technology, the digital businesses, the healthcare tech businesses selling into all those things, the revenue cycle businesses, they're not quite as labor intensive. And there's where there's just a lot more action and excitement currently. Is that partly a fair statement?
Yeah, yeah, absolutely. And I think and I think we've talked about it on this podcast before, but it's really interesting. It kind of swings like a pendulum. 10, 15 years ago, most sponsors stayed far away from reimbursement risk due to all of the operational regulatory challenges that you alluded to. But then over the prior economic cycle, as interest rates were very low and money was easy to come by, there were a lot of sponsors who started to kind of dip their toes or even get even more serious about the space. And they were able to make a lot of money doing so. Now that we're in this new regime of higher interest rates, positive real interest rates, we're seeing the tide sort of recede again as some of those sponsors say, you know what, this just is not a focus of ours anymore, and so we're leaving. And that I think will continue to vex sellers, but I do think it's an opportunity for buyers who remain committed to accepting that reimbursement risk, right? The competition for these deals is declining in many spaces. And so if your shop is good at diligence, good at the operations around these practice management or other businesses that accept reimbursement risk, I think there'll be a lot of hay to be made in 2025. I think that it actually benefits some of those shops. So we'll see how it all plays out. But certainly the uncertainty and challenges of the regulatory environment and reimbursement risk, those are only going to grow over time, right? It's not going to become a simpler business. It's only going to get more complex. But I do think that creates opportunities for the sponsors that are going to focus on the area.
Thank you. And you folks live right at the middle of this middle market healthcare private equity investment. What's the tone and the feel at the firm? Does it feel busy? Does it not feel busy? What are you sensing? Because as professional services firms go, you get a real sense of what's going on in the deal world. Tell us what you're seeing there.
Yeah, busy. It is very busy. We're getting a lot more requests for sort of more limited diligence at earlier stages of the process. And I think this is coming from, sponsors want to they're going to spend more time and more money looking at deals to make sure that they're making the right deals. I think a lot of the sponsors we talk about, they're expecting to look at more deals in 2025, but probably close about as many as they did last year. Hopefully more, but they're not, they're very much internalizing the mantra of, it's always a good deal to walk away from a bad one. And they're very concerned about allocating capital in the wrong way, which makes sense, right? As interest rates increase, the opportunity cost of making your investments increase, and we're going to see a lot more diligence around these deals before they close or if they close.
And one of the fast things you're talking about there is we see more and more deals structured in almost two tracks. The first track being this concept of limited diligence to see if there's really commitment, and the second track being the full diligence and the closings. We see more and more of that. Is that becoming more and more of a trend in terms of how people structure their closing of deals or doing deals?
Yeah, yeah, absolutely. I mean, and we'll see. It's up oftentimes if after the limited diligence, limited look, and I use the term diligence broadly, right? It could be partially financial, it could be a partially a sort of a chart review type diligence or IT diligence or some of all of that, but a lighter touch on very specific areas of concern. And then as the process expands or as the process continues, if the sponsor's still interested, then we'll go to more of a full sort of financial, tax, other diligence that you would expect to see. So overall, a longer process, more diligence, but starting earlier with the lighter touch. And then if if the lighter touch kind of suggests, hey, we think we can make this deal work, then we'll move forward, get into the next processes of the deal, and do more full scope sort of diligence. So I guess the answer is both, at least the
Yeah.
way we're seeing it, right? Again, it's got to be careful in today's deal environment with the investments that we make.
No, I think that's right on. We're seeing exactly that in deals. Early stage diligence and fuller diligence once people decide that they really do have a handshake on what they're doing. Matt, as always, I want to thank you so much and RSM for joining us on the Becker Private Equity and Business Podcast. Thank you so much for joining us today.
Thank you, Scott.